Welcome out to 588 Trading Justice Podcast. My brother Matt and I are just going to have a fun conversation, talk markets, going to break down very extremely interesting markets. I could use a lot of adjectives, Matt, to describe these markets. I find them super fun. I call them my type of markets. Volatility increases, credit traders, they kind of like those type of markets. We're going to break it all down for you, but before we get started, I want to highlight the Tackle Trading newsletter. Matt, I consume a ton of content every week. This is my job, right? Consume content, analyze, share, teach, all of those good things. And to be frank, over the last month, I haven't seen better analysis out there than what we provide in the Tackle Trading newsletter. We have a good feel for this market right now. How good a feel do we have? I run a practice journal portfolio in my Cash Flow Vikings trading lab. Monday, new all-time high. Tuesday, all-time high. Wednesday, all-time high. Thursday, all-time high. Close the week at closing week all-time highs. Because, well, to be honest, part of it is the analysis that we do as a group, allowing me to make decisions as a trader. It's just a fantastic product. So, this newsletter, Matt, it's fun. It's informative. It's the you stayed at a Holiday Inn.
It is the you stayed
newsletter.
At a Holiday Inn
I like seriously. The first time I read it, I talked about that. I'm like, you read this newsletter, it's like you stayed at a Holiday Inn. The whole commercial where it's like, I'm not a doctor, but I stayed at a Holiday Inn last night. So
yeah, my intentions of the newsletter is really simple. We produce a tremendous amount of content for our community every single week at Tackle Trading. So definitely come be a pro member, definitely get that 15-day free trial. But the newsletter, I wanted to basically everybody that doesn't take all the content we produce, whether it's for life, their job, family, whatever, we all have responsibilities, obviously. I wanted to give them in the newsletter the opportunity to be aware of every single thing that we're looking at on a week in, week out basis. And we obviously have videos, written updates. I do a technical update in the newsletter every single week. And I really talked about the needing of a Doji. We'll talk a little bit about that in the podcast, obviously, here. I do an update on earnings season. What's the macro?
And not just the needing of a Doji, because we use this phrase. What does this mean? Right? So it's like educational content that's applicable to the market conditions we're facing right now.
I definitely want to mix in the educational side of it, because we don't just state things. We then state things, then detail it, then explain it, because at the end of the day, we are educators.
It distinguishes this newsletter from any other product similar out there,
But as you can see, obviously we want to make sure that our community is fully apprised of everything. And, we'll talk a little bit about the newsletter and the concepts that we do have in the newsletter, such as our rankings and earnings and so on and so forth. But if you're looking for a newsletter to 30 minutes every single week, including the videos, make sure that you have an understanding of the technical, fundamental, behavioral side of the market every single week. You're going to have a lot of information and a lot of knowledge to attack the market every single week and apply your trading systems and your investing philosophy out there as well. So definitely, we love the newsletter. And so if you have not if you're a pro member, definitely check that out every single weekend. If you're not a pro member, obviously you can head over to Tackle Trading and sign up and test out the newsletter out there.
Yeah, absolutely. Listen, this market, two categories right now. Two categories in this market, and there's lots of subsections within those categories. You have, and this is how we've been defining it at Tackle Trading. We've shared these thoughts here on this podcast. You have second quarter winners, and then you had the left behind in the second quarter. Now, does everything fit nicely into that basket as far as every single stock? No. But it encompasses basically most things, right?
Honestly, it's a very good categorization of what's going on out there in the market, because from quarter to quarter to quarter over the last 6 months, during earnings season, there has been leaders that stood up and stepped out and stood out for all of us, and obviously led the market and started, trending fairly aggressively following the earnings reports. We saw that all the way back in last October, last November, when we started seeing that cyclical, move for the first time, all the way back. I know it feels like a world ago, but you know, when you're looking at the Dow Jones, for example, you see all the way back in late October, early November, where the market starts really kind of pumping. And in that quarter, it was really kind of cyclical that took the charge and outperformed everything else out there. And then in the first quarter reporting season, you started seeing kind of everything kind of do simultaneously fairly similar things. But in the first quarter reporting season, you started seeing the AI trade, technology, semiconductors, the aggressive areas of the market, Mag 7, really lead the charge. And for that entire quarter, from the first quarter to the end of the second quarter, it really has been the AI trade versus almost everything else out there. When you look at technology in that quarter, technology up from quarter to quarter. Obviously, technology is now showing a little bit of selling behavior as we do start going through that second quarter reporting season. Well, as technology really took hold last quarter and had a beautiful trend throughout the entire quarter, what was left behind? Well, pretty much practically everything was
everything else.
When you're talking about the Dow Jones, the Russell 2000, ultra growth in the ARK index, as illustrated by ARK, everything was kind of left behind in that last 3 months. And so what we're seeing now is the development of a pattern, and not the first pattern we've seen from this quarter to quarter type analysis. We saw it in the last quarter of 23, we saw it in the first quarter of 24, we saw it in the second quarter of 24, and shockingly, we're now starting to see it in the third quarter, whereas you start to see these early moves from what we generally categorize the left behind markets. And so as technology is starting to sell off a little bit, and there's some catalyst stocks that really kind of drove that technology move this week. Well, what's starting to take hold in trending analysis is those left behind areas of the market, like ARK. Obviously, we're looking for the ultimate confirmation of an increasing in support level, and that's the concept of need a doji and trend analysis and patterns within a trend. But at the end of the day, Mark, what you are seeing is some standard rotation from those aggressive areas of the market that have done really, really well in the last quarter to kind of flow out of those areas into areas of the market that have been left behind. And once again, that categorization is symbolic and illustrated as through the RSP versus the SPY. Obviously, RSP is now starting to trend. SPY is coming down. When RSP is trending and SPY is coming down, it's because the 475 stocks that are the quote unquote left behind markets are starting to trend versus the leadership in the market, technology, Apple, Google, Meta, obviously the semiconductors, NVIDIA. They're starting to go through some fairly aggressive selling over the last 3-4 trading sessions. And so you're seeing the S&P down, but RSP up. Well, it's because the other 475 stocks are not going through profit taking right now. And so when you're looking just in general at the S&P, it's given you a little bit of a misread right now. And the S&P has given you a little bit of a misread throughout the last 3 months as well, as the S&P has been bullish, RSP has been neutral.
You know, and I want to, let's just spend like 30 seconds.
Yeah, last point really quickly. Now what you're seeing is RSP bullish, S&P is slightly, I wouldn't call it bearish yet, but you know, obviously some bearish moves there. It's fascinating, but it's just polar opposite of what we had been seeing.
Yeah, no, like, and I think this word misleading is very key to understanding, you know, because Jeffries, for example, stopped covering the S&P a few weeks ago. Mm-hmm. What was their thing? They're like, it's not an indication of the market, right? So they just said, we're just not going to cover it. We're going to cover individual stocks because it's not a
very important conversation, by the way. The S&P has been the barometer of the market for the last 25 years.
You know, and you have a major bank saying, we're just not going to cover this anymore because it is not reflective. Now, will those correlations come back? Yes. I don't believe the correlation between the S&P and the market itself is dead forever, but it has been in 2024. And so not only, and this is important, not only was it misleading in the second quarter, it's been misleading over the last week.
Good question, though. The way the mega cap stocks trade with the large moats in the future, Mark, don't you think Jeffries is kind of onto something, though, in the sense that
I don't think they made a
RSP and SPY is never going to be 100% correlated.
I think they made a thoughtful decision. I don't think it was they woke up one day and said, you know, because that's That's a big decision at an analyst company.
Well, it is a big decision, but it's also a very similar decision that Tackle has been making over the course of the last 6-7 weeks. We've been including, we ranked the S&P.
Yeah, talk about this, because this is a big deal.
Yeah, we rank the S&P 500 every single week in our newsletter. Like our rankings of tackle trading, we've been ranking for a decade now. The markets, the sectors, the S&P 500 itself. And when you're looking at the S&P 500 in the last 5-6 weeks, despite the S&P being very consistently bullish, we maintained between a 30 and a 25 ranking on the S&P despite that bullish uptrend. And for like 4 out of the last 5 weeks, I've been referencing we are maintaining our ranking in the S&P despite the bullish uptrend because of the divergence between SPY and RSP, which is exactly what Jeffries is talking about. And even this week in the newsletter, I literally talked about that exact same thing. I didn't know Jeffries was going to talk about it. But I talked about that exact same thing when I said recently we've incorporated the equal weight S&P 500 RSP into our broad market analysis because, Mark, you kind of have to now.
You have to.
Doing is looking at the SPY. The only thing you're really looking at is the weighted areas of the market that take on a greater technical importance than what you're seeing in RSP, and so you're just not. And honestly, this is a big deal because for 25 years, the S&P 500 has been the barometer for any degree of analysis that you wanted to look at the actual broad market. I don't feel comfortable looking at the SPY ETF that represents the broad market and saying this is exactly what the market is doing, because we all know that the market is not simultaneous, all selling off over the last 3 days. We have trending analysis happening. The craziest part about this, Mark, is you have trending analysis starting at the very beginning stages of trends within RSP, and you're starting to show early signs of reversal analysis within the broad market of the SPY itself. So tell me the last time you're looking at the exact same index, RSP versus SPY, one showing increasing volatility, the top end of a trend, and the other one showing multiple time frame breakout scenario. That's crazy to say, and yet that's exactly what we're seeing in the market. And so I do think you can't just anchor, and I think Jeffries is right. I don't think you can just anchor against the S&P 500 any longer because you are overweighting everything you're doing to the AI trade and technology and semiconductors. And so I do think you have to take into account RSP, and I do think you have to take into account cross-index analysis on IWM, the diamonds with the S&P 500. That would be obviously the S&P from the barometer, but to get the context of what IWM, the small and the mid cap areas of the market, what the Dow Jones is doing, the very economically cyclical areas of the market. And so I do think in general, RSP is becoming a more important part of the analysis than even the SPY is. Well, I think the SPY
it is
a misread.
And this, this trend has been going for a while. For example, in my Cash Flow Vikings trading lab, going back over a year, I was openly stopped advocating, like, listen, you cannot use SPY hedges to hedge a diversified portfolio of stocks because you can't do it. Now, you used to be able to do that kind of stuff.
It was the number one-to-one hedge is put options on the SPY. It's not the one-to-one.
And over the last year, and this goes back to, I mean, even longer, like, because you started to see this correlation breakdown like in the spring of, after the banking crisis, where remember 2023, where tech started to outperform everything. And it was, obvious to me at that point, it's like, well, we can't use SPY hedges that doesn't work. And I thought it might just be a short-term thing, but it just doesn't work.
And again, I don't think it is a short-term thing anymore.
Well, we have
you can't tell me that the mega cap stocks are now defensive stocks with the large mode argument and tell me that the SPY is going to behave the same way it always has within every market cycle. Obviously, those things are now different. And so the mega cap stocks, they're nation states, Mark. They're little mini indexes in and of themselves. And so it's, if you wanted and I'll just end on this because we don't need to stay on this topic the entire time. But if the only thing you're reading is the SPY, you are getting a little bit of an oversized technical read and not necessarily a broad market read, which means you need to take into account the other indexes and specifically the equal weighted RSP in your analysis to get a better understanding of exactly what the broad market is doing.
Yeah. I love this market.
Or you can just rely on Tackle Trading's rankings because we do that already.
Yeah. I love this market right now. And this very much feels like a trader's market. And a trader's market is when you have a lot of choice. Matt, it's felt like for a while I had one choice and it was all the same trade. Right? Like, you know, it's like I could trade Broadcom or I could trade NVIDIA or I could trade Apple, but
you can throw a dart at whatever semiconductor you liked.
You know, and it was just like, all right, which one do I think is going to, but it all felt like generally the same trade. That's not how this market feels like, right? Even within the RSP, Dow, TNA, I think you're going to see some perform. Certainly components within those perform better. You're going to see more diversity of stock selection. I'm seeing quality companies off the bottom of charts such as Mosaic and Pfizer, things that are like, oh, these charts look the most interesting they've looked in a long time. I got a wide diversity. And I think
9% of the S&P 500 is in some degree of bottoming reversal pattern right now. You can
man, that is a massive percentage. I didn't know that. I did not know that. That is
some reversal analysis looking for bottoming opportunities this morning, and there was 40 out of 40.
Oh my goodness. That is a trader's dream to have that kind of choice.
And they're all right in front of earnings, which means you're going to have an earnings scenario where they could be confirming reversal analysis post earnings. I mean, you know, the beautiful thing about the rotation into the RSP, if we do get some trending confirmation here, Mark, is you're going to have more stocks coming from low and mid tier opportunities than you know what to do with,
because
that's a good thing. That's a really, really good thing,
because I hear all of these bears out there talking about, you know, how overvalued the market is, and all they're really doing is the same S&P 500 analysis that Jeffries has abandoned, that we've moved away from. Right? It's just like
the exact same mistake that a lot of
let's use one metric and then apply there, like, go tell me Mosaic is overvalued. Go tell me Pfizer is overvalued.
There are areas of the market that are historically overvalued right now.
Yes.
And that obviously is a true story.
And CrowdStrike was historically overvalued, and then they blew up the internet.
We are currently in the second or third most overvalued market in the history of mankind in the U.S. market.
Yeah, really don't want to blow up the internet at that PE ratio.
No, you just waited. You've been waiting to get your CrowdStrike joke in. I went short CrowdStrike, by the way. It's a wonderful company, and you're at the 200-day moving average. But enjoy the jokes on CrowdStrike. Wonderful company. We'll see what they do at the 200-day.
You know, but we got a lot of choice, Matt. And I think the big question heading into this week right now is like, all right, so I got some choice, right? I got some stuff that finance, small caps, Dow, right? ARK. I would put biotech in there. I got a lot of choice heading into this week, but I had a little pressure, you know, and I thought, like, you know, I didn't know you were going to write this section in the newsletter this weekend, but you did a section called Needs a Doji. And I called you up, as I always do, read the newsletter, give you my thoughts, see what grammatical mistakes might have been made. I didn't catch any of this this week. And I said, perfect topic, because that's in so many of the areas that it feels like we're going to have some degree of successful rotation. We're just missing what we at Tackle Trading use the phrase, oh, that just needs a doji. And you explained in the newsletter what it is. Spend a minute just talking about that, because it's a really important concept as we start this week.
Well, I think it's an important concept because technically what we're seeing right now is selling behavior in the aggressive areas of the market, obviously led by technology, and that selling behavior has obviously violated pattern and trends within technology. And so you're certainly not looking to buy a dip against a violation of support and a violation of trend. You put technology on the radar of post earnings analysis, quite frankly. And so technology needs a moment to simmer down here. It's got a lot of volatility. It's overreacting to even small pieces of data, and you need to see that settle down and settle in before you have too big of an opinion regarding the sell-off within technology and the opportunities on the bull side that may manifest. Because I would
And
not.
we have a question from a student that we will have in a segment later on that says, "What should I do with credit in technology?" We'll talk about that,
Okay.
here in a few minutes.
But in terms of the analysis here, you gotta put it on a post earnings conversation. The amount of time between the development of whatever pattern at the low point here on technology will take a little bit of time to develop, and that's right in the development of when we start getting into some really, really important earnings conversations on the technology side of the equation over the next 2 weeks. And so you look at the volatility of technology and you just basically say, okay, we're waiting on the next trend, period, end of sentence. We're waiting on the next trend. And so technology is kind of a area of the market that you're not going to be focusing on here. But Mark, you get a Doji in technology and you start to see that as a support build a little bit. When you're looking at the other areas of the market, the Nita Doji conversation is extremely important to us to tackle trading, and it's almost doubly important this week as we're navigating the market, because what we are seeing in the face of that selling behavior within technology and the overall mentality that we've seen at the very beginning of earnings is left behind markets have gotten a bid, finance has gotten a bid, energy has gotten a bid. Finance and energy is from a valuation perspective the two lowest valuation areas of the market. Finance has had a wonderful earnings season. I in the newsletter yesterday I said, you never expect finance to hit a home run batting in the leadoff spot, but you just want them to get on base, and finance pulled out a double.
And of course, my brother used a Ricky Henderson from his favorite baseball team, the Oakland A's, analogy.
He's the greatest leadop hitter of all time. So it was the first one that came.
Don't think I didn't notice that, by the way.
I almost went all first person and had it did what Ricky does type moment. But in terms of the Nita Doji, it's basically a concept that when we're seeing the beginnings of a bullish retracement, and as you navigate the concept of what is called the depth of the retracement, because when you go through bullish retracement, a bullish retracement is a secondary pattern within a bullish uptrend. It's the pullback analysis it's the buy the dip analysis. It's that structured retracement. And in that retracement, there are 3 levels we track in a retracement. You track the momentum pullbacks, which is typically down to the 9 EMA. If the market doesn't maintain the standard momentum, you track the standard retracements, which is usually between a 38 and a 50% retracement against the previous wave, and typically somewhere around the 20 period moving average. And then you tracked what is known as a deeper retracement, which oftentimes encompasses that 61% level on the Fibonacci, and oftentimes the 50 period moving average within the short-term trend. And so the Nita Doji concept goes to the concept of a pivot analysis. And when you're looking at a pivot of support in a trend, the two patterns that you have to have within a trend is an increasing resistance level, which we absolutely do have in the Dow Jones, in ARK, in the Russell 2000. We have seen that increase in resistance level, and it was a real textbook increase in resistance. And now what we're seeing right now is the pullback. And the open question,
which is also pretty textbooky at this stage.
It is, but the open question right now technically is the technology sell-off, is that kind of the leader in the horse race, and is that going to continue to pull back down the Russell 2000, the Dow Jones, the ARK?
Basically, does it create so much volatility that it carries over
back down, right?
Yeah.
Well, that's why we need to track that Nita Doji, because in technical analysis, when you're going through pivot formations, A pivot is a 3 candlestick formation. You have the first candle, which is typically called the preceding candle, which usually comes down and establishes some degree of support bounce. A very good picture of that would be on the RSP right now, where you have an increase in resistance level up to 172. You're looking at a 2-day pullback down to 168, where you basically have this old resistance level and the 9 EMA. And so you have this old resistance, which is now acting as new support, and you got the 9 EMA right there. Well, Mark, this is a standard bullish retracement. It's a standard bull pullback. It's a standard what we refer to as a Cody special, which is a retracement that kind of comes into the previous level of the breakout channel. And the only thing you need to see is you need to see it go through the pivot formations to confirm the initial breakout is not just a breakout with a fake out, but the initial breakout is something real. It stuck the landing, and now we have an increase in resistance plus an increase in support. And so the Nita Doji concept goes to pivot analysis, because in pivot analysis, you have 3 candles. You have a preceding candle, which is a bearish down candle, which establishes a support level, comes into a support catalyst. Then you have what is known as the Doji candle, or otherwise known as a slowing momentum candle. And that's when you want to see that slowing momentum on the daily chart, which would be a U-shaped reversal on the intraday chart. And then you get that upward movement in price, Mark, and that confirms that you are now.
And for me, that is an actionable signal.
Well, if that
that is 100% actionable signal.
Any actionable signals in the entire marketplace, and so
Matt, I cannot remember a week where you are entering the market looking for one technical pattern in such a broad-based format. Like it's been
a lot of bears in the last 2 days, but I want to remind the bears of the last 2 days that every single area of the market is currently sitting at a support level.
Boom. Right. But like, no, like I cannot remember, like, because like, and this can come in a little bit of different flavors, right? We might form a classic higher low, break intraday support, take off. You can trade sideways for a couple days. You can, I mean,
well, it doesn't matter what the pattern takes. If the Nita Doji concept goes to analysis, not a single candle. And so the Nita Doji is a reference of a pivot formation, and we need to go through that pivot formation, which has a minimum standard of 3 days. It's not a maximum standard. It is a minimum standard.
And Matt, this is such a big technical formation, because it's actionable for directional traders. It's actionable for credit traders. It's actionable for aggressive credit traders.
Not just that, Mark.
You know,
it's not just that. You gotta think more bigger than that.
Yeah.
And I'm serious on that one. It's not just an actual trade setup. What you're talking about is a multiple time frame breakout in 475 stocks in the S&P 500 in the entire left behind areas of the market. You're talking about a thing that we have been talking about, waiting on for literal months. We've been talking about the potential of a multiple time frame breakout.
Matt's breaking, like Matt, classic swing trader, breaking out his position trader mentality.
Well, yeah, if you're talking about a pattern that goes quarter to quarter, I'm not just thinking about it.
He's breaking out his position trading mentality.
I think you have to be looking at it. And quite frankly, post earnings, you should, when you go through a technical formation post earnings, you shouldn't just be looking at that post earnings situation as a potential swing trade, because earnings are catalyst type opportunities. You should have a little bit more of a longer term purview on that type of situation. So yeah,
good advice.
Am I looking at this, pivot formation in the Russell 2000, in the Dow Jones and in the ARK as an actual swing trade situation? Of course I am, but I'm also looking at it from a confirmation of a trending perspective. And so if you're talking to me about the confirmation of a pattern, that's swing trade. If you're talking to me about the birth of a new and the confirmation of a new trend, that's more position trader analysis. So the 2 timeframes I think you're looking at right now, as we navigate these pullbacks here, is probably the swing to position trader analysis.
There are, and you're looking at the Dow small caps, RSP. RSP is the most important of the three for me because it has the most stocks that I have on the radar, personally. And if you had the most small cap stocks on your radar, small caps confirmation would be. But like for me, I have like that is just the bulk. Blue chips that have been left behind, looking for some RSP confirmation right now. There's a good chance Dow, RSP, Russell, at least in the early stages.
Be the broad market, looking for broad market confirmation. Russell's looking for a specific Russell 2000, small and mid caps. Those are obviously economically sensitive. But again, it's more about if you see these higher lows start to set in, and Mark, we're testing momentum pivots here. You could see a little bit further downward movement in price and still maintain this.
I don't care where it occurs, bro.
And so whether it occurs at the 9 EMA or whether it occurs at the 20 SMA, you are starting to see the first beginnings of a development of a trend. So yeah, I do think it's very interesting in looking at the RSP and specifically the Dow Jones, specifically the ARK, and seeing if we do get pivot confirmation this week. And if we do get pivot confirmation, it's obviously that's where all the conversation is going to be.
Yeah, I'll talk about tech in a few minutes when we get into some listener questions. I want to turn our attention to earnings right now. After I gave you a compliment on the Doji when I called you last night, the second thing out of my mouth was I need more blended growth data because you've made me a true believer. And when I saw,
I take great pride in making you a true believer on blended growth, by the way.
Yeah. And when I saw, because I read the newsletter as a consumer, other than the sections I wrote, obviously, and I saw the 9.7 blended growth to this point. Now we're in the early stages of earning, got 150 companies this coming week, about that number, the fall. I mean, it's a biz stretch ahead, so we're in the early innings. But I was like,
I'd be shocked if the number doesn't get above 10, though.
But I'm like, 9.7 is a very bullish number. Because
biggest number since 21.
And it's not only that, we talked about this a couple of weeks ago, is that against high expectations, right? The expectations this quarter were the highest they had been in a long time. And, both you and I are of the same opinion that yes, markets can go volatile and you can have some gamma unclenched and over positioning and cats and dogs in the streets just yelling and screaming. But if earnings come in really solid, there's only so far any volatility will take us.
If earnings come in really solid in an environment where the Fed is going to start reducing the restrictive monetary environment,
that's not the backdrop for the big bear market.
No, I'm sorry, it's not. It's not. In fact, it's the backdrop to pick up, to focus on Russell and the current trends that are developing right now. But you don't leave technology. In fact, you probably say, all right, gap down on earnings and let's pick it up at the lower price. But no, it's not a backdrop where you start thinking about the end of the world market analysis, right? From an earnings perspective, Mark, blended growth improved up to 9.7 this week, and it was on the backs of finance. Finance had a really good start to earnings season. Bank of America, Goldman Sachs. They all came through this week. You did have some couple negatives out of the banks, such as Charles Schwab and Wells Fargo. But outside of that, the banks for the most part, JP Morgan led the charge. Goldman Sachs was great. Morgan Stanley was fine. Bank of America was really good. Increased dividend. And even outside of that, Discover Financial Services, outside of the banks, Discover was an awesome report this week. DFS breaking out of a multiple time frame perspective right now as well. So the banks had a really good report. What brought it down a little bit was some earnings coming out of the energy space. That is bringing it down just a little bit. Healthcare was mixed this week. Healthcare had a really important week, but it was relatively mixed. You had companies like Johnson & Johnson, United Health do really, really well versus Novartis and Abbott Labs not doing really well. So healthcare was a little bit of a mixed bag, but in general, I would say finance carried the heavy bag so far at the very beginning of earnings. What's really interesting on the earnings, and what I think is extremely important to understand this week on the earnings front, is yes, you do have macro numbers improving, blended growth improved, beats on revenue improved, EPS is beating the 5 and the 10-year average as well, coming in at 80% beat. One concerning data point out of the EPS side of the equation is the veracity of the EPS beat, which we call the beat percentage. That's not close to what we typically do see so far. And so yes, blended growth is improving, but the average of blended growth improving, we should be talking somewhere between a 14 and a 15% blended growth number by the end of the earnings season, with seeing a little bit of the veracity of the beat being a little bit concerned. We're probably not going to get that number. I said if we get anywhere around 13, we should be perfectly fine. And there's nothing I've seen in the first week and a half in earnings season to suggest that we're not going to get there, because the biggest dogs that have an impact on blended growth we haven't even seen yet, Mark, and that kind of starts this week. But a couple earnings reports just to kind of highlight in the podcast here, because I do think it's important, was ASML here. Talked about them last week as being one of the more important earnings reports that we were going to talk about this week. They were the first AI name semiconductor of importance to report in the season. And they're also one of the first AI names in the earnings saga since NVIDIA came to the stage 18 months ago saying, hey, look at us, look at us, look at us, to lower forward-looking guidance on an earnings analysis. And one of the concerns on the AI side of the equation is in this initial build-out where you have just billions and billions and billions in CapEx spending and R&D spending out of the big dogs, that companies like ASML, which are an infrastructure play, as they start to slow down, NVIDIA starts to slow down, because if NVIDIA is not ordering as much from ASML, if Apple's not ordering as much from Taiwan Semiconductor, well, obviously that's going to have a trickle-down impact. And so we saw lowering of guidance, just a hair, but it was a lowering of guidance on ASML. That's what triggered the aggressive selling behavior in the semiconductors, in technology this week. That's what triggered the entire selling behavior, was the lowering of guidance out of ASML. Now, what's important here is that triggered the initial sell, but we have not seen further confirmation of the slowing down of the fundamental side of the AI trade, because Taiwan Semiconductor, they did not follow suit with ASML. Taiwan came out with slight beats on EPS and revenue. They increased forward-looking guidance just 2 weeks ago, Mark. They came in at the top end of that forward-looking guidance. And so you're seeing a bunch of stocks get caught up into some hypothetical scenarios that ASML kind of brought to the forefront of concern in the AI trade. We're going to get a very good understanding of that this week as we start to get Google and we start to get some other big dogs out there like Tesla on the AI side of the equation. Obviously, a different conversation. They're not an infrastructure play like ASML is. But I just wanted to make sure that our community and the listeners of the Trade and Justice podcast, that they're aware of that ASML situation and the guidance situation, because that is what triggered a lot of the aggressive selling this week from an earnings perspective. So ASML, I thought they could be a catalyst stock because they were the first one. They were on the downside, triggered aggressive profit taking in a lot of the semiconductor areas. And now obviously technology is waiting on an earnings saga to change this story, Mark. And that's the importance of this entire thing. When you know there's a story being embraced by the market that fits some of the concern that the market participants had coming into earnings season, you don't want to just rush and try to fight the price action here. You don't ever want to catch a falling knife. Let it settle in. Let it go through reversal analysis. But again, if we do not see out of the other areas of the market in technology and communications what we did see out of ASML, this gap in sell down behavior we're seeing in technology initially could be seen as a gift down the road, as it allows us to pick up quality stocks at a cheaper price.
Yeah, now let's give a little earnings preview, right? We're getting into the bulk of it. A lot of interesting names this week. It's the type of calendar where basically you got names reporting every day. You want to, for the YouTube audience, do you want to pull up the little earnings whisper calendar that the entire investing universe uses?
We all like it. Yes.
Yeah, like it's just they've become the thing. But Matt, Tuesday after the bell stands out this week. you know, to well, I don't know, just about every
Everybody.
like right. I mean, names all throughout, right? But Tesla and Google, same,
Tesla and
same.
Google, Tesla and Google is going to get all the love on Tuesday. There is absolutely no doubt about that, and justifiably so. They are the two most important stocks to report this week. However, on that same Tuesday, Mark, I think we're going to be talking about Tesla and Google in the Traders Lounge at Tackle Trading, but I'm going to guarantee you, maybe not of equal importance, but sneakily, Mark, there are 28 industrial components reporting this
Oh,
week.
that's a good. I didn't know that. Like, yeah, that's a good take.
Industrial components reporting this week. And the entire conversation right now is on whether or not that initial defensive and cyclical areas of the market, the quote unquote left behind areas, are going to confirm a pivot or not. That is the number one question that everybody should be answering this week is, does those left behind markets that are finally showing a little bit of momentum, is that momentum real, or was it just nonsense because it was something not named tech when tech was selling? Well, Mark, yes, Alphabet and Tesla on Tuesday is great, but you get GE Aerospace on Tuesday as well in industrial. You get UPS in industrial. You get General Motors in industrial. You get FCX, Freeport McMoran in industrial, in basic materials. You got Lockheed Martin. There's a lot on Tuesday. There's a lot this week in general on the cyclical side of the equation, but that's going to be the case when you go from 9 stocks reporting on week 1 to 38 stocks on week 2 to we get I'd say about 25% of the entire market, over 25% of the entire market this week. And so sneakily, the industrial side, it has some really important reports this week. And so the most important catalyst stocks here, if you're looking at Monday, okay, the most important catalyst stock on Monday, I would personally say is Cleveland Cliffs, because of what some of what we're seeing in basic materials and steel companies, and especially for our community, Cleveland Cliffs is going to be.
I own Cleveland Cliffs, for example.
Nucor also is on Monday. So Nucor and Cleveland Cliffs, if you're looking at steel companies, you're looking at material companies, that's going to have an oversized importance on Monday. On Tuesday, yes, Tesla and Google, that's the end all be all. But again, we're going to have some secondary analysis that is equally important to understand whether or not we do get that pivot we talked about in the podcast earlier. On Wednesday, like CMG, this is their first report after they split 50-1. And we're now going to see CMG from a different perspective. And so I'm actually excited to break down CMG's report. And I think they're in some compelling technical side of the equation. Ford and Newmont Mining also stand out. Boston Science stands out.
Boston Science is it's on my watch list.
That's an AI name in the healthcare space. ISRG was the other one. They reported this week, and we actually have ISRG on the traders report following a gap out. Sneakily though, Viking Therapeutic is on that list on Wednesday as well. So a little bit of a mixed bag on Wednesday. On Thursday, another little bit of a mixed bag here. I would say on Thursday, the most important name on Thursday, Mark, I don't know about you, but I'm going to say Honeywell. I'm gonna go back to the industrial well there. Honeywell can be a catalyst stock. RTX is also one of those catalyst stock on the aerospace and defense side of the equation. And then on Friday, you got Bristol Myers, which I really don't care about. 3M, which I really don't care about. Actually, I take it back. 3M, I do have some interest on Friday. So we got a big earnings conversation this week. We're going to detail every single degree of this earnings conversation in the Traders Lounge for the pro members that tackle trading. And then at the end of the week in our newsletter, obviously we'll have the best reporting stocks in our quick hits on the bull quick hits. We'll put the worst performing stocks on the bear quick hits, and make sure our community has a understanding of the entire earnings conversation. And then like we did this week, we'll do an earnings update in the podcast as well.
Let's talk global markets now. Selling pressure was pretty broad on Friday. oil, gold, along with a lot of areas in the equity universe. And a lot of this, well, not Bitcoin, but we'll talk about that here in a second. And a lot of this is attributed to a pretty power 2-day move, right? That I think caught commodities off guard.
Yeah.
Right. Like, and that's where, I'm settling here is like, all right, you had a breakdown. There was this feeling in commodities of comfort. And then you had this power move in the dollar. And I think it just unsettled things like, oh, we weren't like, as speaking as the commodity universe, weren't expecting that. All right. And that caused some volatility unexpectedly. Do you think that's a reasonable take on what happened to end the week?
Yeah, on the commodities side, the commodities side got beat up a little bit to end the week with the dollar kind of faking out against that 104 level mark. But now we're looking at a little bit of a bearish retracement, and if you pivot on the dollar in that bearish retracement, it is going to put a lot of pressure back on that 104. So, yeah, I would agree with that. Now, what caused the fake out a little bit this week and the unexpected volatility the last 2 days in the commodity space, specifically on the copper and the silver side of the equation, would be you had the Europeans come out and announce monetary policy. And the Europeans were not expected to cut. They cut already 6 weeks ago. So they were not expected to cut here. But the way Christine Lagarde talked about the September meeting was there was not a guaranteed cut in the September meeting, which basically put them on par with where the US dollar is in the central bank of the United States regarding the path of policy. And so you just had a little bit of Christine Lagarde saying, hey, we got to rely on data. We got to rely on data. We need to see more data to confirm more trends. And that basically just brought that the euro up, the euro down, dollar up. And so that kind of created.
Now, you're my currency expert. That same news, if the dollar was near resistance, doesn't feel like it would have had the same oversized move.
If the dollar was at 106, it would have been at 105 by now.
And so
this is a real simple one, Mark, because the Europeans don't really do anything.
Yeah, if this feels like just one of those
important here. And so if you're at resistance, you probably sell. If you're at support, you probably buy.
It was going to be interesting on the technical breakdown. I saw one of the, one of the bigger candles on gold that we have this year. We've seen a couple big candles over the last 3-4 months. There generally, Matt, has not been any, not generally, there has not to this point been any follow through on volatility in 2024. You get these little pockets and maybe you get another day. It would have surprised me to see gold sell off on Monday, but that has followed with bottoming formation, support levels being formed. That's been the pattern. GDX actually was a little tiger on Friday. Didn't want to get caught up. Actually, I finished closer to the highs than the lows, even though gold didn't. I found that interesting. People didn't want to let go of their shares.
Covered at 41 last week. I'm thinking about pulling it off this week. What are your thoughts?
Dude, I'm a credit trader. I just smash credit.
I know you do, but my $41 call option doesn't have a lot of premium.
Oh no, if it doesn't have any premium, then just follow your rules.
It's either to leave it uncovered or to rewrite, right? To rewrite, and if you're going to have to rewrite on the covered call, you're going to have to cover down around 39 to 40, and I'm not sure I want to be covered at 39, honestly.
I mean, this is like genuinely I'm going to sell. I'm going to make my gold positions on Monday more.
I don't like a covered call here.
I'm going to add credit on Monday, like in out.
But you're going to add a naked put.
Well, yes, I'm going to add more conservative. Yeah. So it's, but that lets you know I'm not exactly bearish, right?
But my point is, adding a naked put in a bullish retracement is maximizing range and probability. That's perfect. That's like ideal for a naked put. For a covered call, that's nightmarish.
So
the very reason you want to do the naked put is the very reason why I don't want to do the covered call.
I know. Like, listen, I don't ever have to have these perplexing questions. I just smash credit and figure it out later.
See, but then you complain when you don't catch all the.
Yes, I complain in big trends. Yes,
if
I
we
can
pivot here and head back up to 40, you're going to complain a little
no,
bit.
but and once again, like rinse and repeat the conversation Matt had on need a doji pattern development, and you can apply it to gold, you can apply it to gold miners here as well. Same conversation.
But,
Uh,
but aren't you interested a little bit here on the directional side, Mark? And the reason I say that is, again, when you get the unique scenarios of bearish retracement simultaneously with a bullish retracement, a bearish retracement on the dollar simultaneously triggers a bullish retracement on gold. If the dollar pivots here, like gold and GDX are both in bullish retracement scenarios, which appropriate to look at it from a short-term trading perspective, not just the traditional longer-term scenario. So a doji here in the gold markets, you'll like that just as much as you'd like a doji in the Russell 2000 or the RSP right now.
Yeah, no, absolutely. And I have a hot take coming up. I'll share that with gold. Now, crude oil, on the other hand, had a candle that we haven't seen in a while and really came out of nowhere. This
Crazy
one,
just crazy.
like this one surprised me. Like, just genuinely, like no catalyst, right? Volatility spread, sure. But that was a big move on crude oil. And you could say, well, the dollar went up. The dollar and the oil aren't correlated anymore, people. Stop using your grandpa's playbook.
I'd throw up a little bit if you made that argument today.
So it's not dollar analysis, right? It wasn't, there was zero economic data that came out on Friday. There were no policy announcements,
it's
right?
the exact opposite candle that you got on Wednesday. You got a big down on Friday, got a big up on isn't that just symbolic of the lack of consistency here in crude oil in general?
Yeah.
Both from the, and I'm not just talking about the last week and a half in price action. I'm talking about the V shape on the downside, V shape on the upside. Early June, I'm talking about the lack of consistency in wick analysis and candles throughout the past, months. It's why we at no point
it's a change in behavior.
Crude oil, but we do like energy, and I'm going to tell you right now, I still like energy.
See, like
I do.
I know. Listen, I get it from a technical. Like if I didn't know, and once again, it's the same analysis. As long as crude oil doesn't get wild, right? Like, absolutely, these patterns, valuations, it's such a gorgeous story. In fact, we would have started talking about this without that red candle probably 40 minutes ago, right? Because it's really compelling from a technical fundamental perspective.
Give me a doji right there at 92 on the previous breakout channel of energy. That looks really
okay. I got a question for you.
Need a doji is the phrase.
But okay, this is one thing. You get another big red candle in crude oil, you get a doji on XLE. It can't be as appealing though, right? Like,
okay, so the question is, at what point on the chart do I get concerned about crude oil regarding my energy call?
Yeah. Okay, pull up the weekly. Guess what? Out of nowhere, we're having a 200 weekly conversation.
I know.
Like out of nowhere. Like I was not prepared for that on Friday. Like, oh my gosh, here we are, 200 weekly again.
I 77, you breach 77 right where the 200 weekly is. That 77 is right there on the old pivot, old support level. You breach that, I'll have a little bit more concern. But again, to me, it's fundamentally the argument is as long as crude oil stays above a certain level, we were saying $80, that we still like the energy trade. To me, I like the energy trade as long as it stays, as long as we're going through reversal and we have the ability to create an increase in support level against that reversal analysis. I think that is the most important form of analysis, given the fact that energy is the most undervalued area of the market. So I still think that's there. I think the earnings saga of energy's a little bit more interesting to me than the crude oil saga of energy.
And we don't have any big energy companies this week, do we?
No, we had Schlumberger last week, and
but none of the producers, none of the.
That's 2 weeks from now.
So
I would say as long as last week I was saying, okay, as long as you stay above 80, Mark, but that was also coupled with if you breach 80, you probably violate something on energy, but you didn't. And so are we seeing a little bit of an oversized movement on crude oil due to algorithms? Because we are not seeing this in the actual energy space yet. So
Listen,
to me, it's
Janet's out there being like, listen, we're losing the election. Do something. Short something. Short oil now.
maybe.
But listen, it follows the general weakness in commodities we saw throughout the week, right? Copper's down, uranium's down, iron ore's down. Like you saw some real weakness in commodities. It could be that oil just caught up to that volatility that had already been going, right? But you saw weakness in cyclicals.
Maybe. That certainly could be the case, but silver is still fighting towards the top end of its overall trend here. Obviously looking at reversal, and certainly got caught up in the last couple of days. And you certainly got to be concerned at 26 on silver, on the ETF of silver. If it breaches that, that's a confirmation of a reversal on the top side. But I would say copper is different from silver, and I would say some of the cyclical commodities have separated themselves in this saga. You obviously would say the copper move is more relative to what's happening in China. You're seeing a little bit of that on silver. You're not seeing much of that on gold in any capacity. And oil, I do not put the dollar and cyclical commodities in the same basket as oil.
Yeah, it's just a little like, it's gonna, I go back to the Saudis have your back, but they don't have your back anymore. And this is a situation where, like in the past, and this is like for me from a trading perspective, how I treat these situations. For the last 4 or 5 years, I'd see a down move in oil, and I'd be like, well, Saudi Arabia will be there to scoop that up. Maybe not at this level, but a few dollars.
I don't have confidence on the Saudis got your back analysis.
I don't, and that is no longer there, right? That is no longer there.
Have your back as much as they once did, and so. Yeah, I agree with that. But
I'm gonna
to me, I'm gonna be tracking the energy reversal. This still looks really, really good on the reversal, and I don't see it showing the same degree of volatility. But Mark, obviously, if you start to see this crude oil spiral, yeah, it's going to pull energy down. There's no doubt.
Let's go to the new Trump trade, Bitcoin. Listen, following the assassination attempt last weekend of President Trump, and we're going to talk more about Trump stocks in coming podcasts, what a Trump victory would mean, kind of waiting to see who his actual opponent is before we have that podcast.
Well, there's some uncertainties in the probability analysis on those things, right?
Oh, the betting market is wild. Who's it going to be? Biden, Kamala?
Listen, it's okay. It's going to be Kamala. That's what it's going to be, and it's most likely going to be Kamala, and most likely Ben Shapiro or the guy from Kentucky, Andy Burchard. That's the most likely scenario. But again, we need to see that come to fruition.
The Biden administration just put out a press release that refuted everything you just said. Said no, Joe's in it to win it.
Of course. Joe's standing on an island right now. We'll see how long that island can hold him.
But and then after that, Bitcoin got a bump over last weekend as there is big policy differences. Now, Trump hasn't exactly laid out a crypto, but he's been like, yeah, I'm friendly with crypto, right? Like, just like okay. It's not like he's laid out this detailed pro crypto, but friendly.
Trump does not have a detailed crypto plan. What Trump has is a Vivek Ramaswamy who does have a very,
but he's not anti, which one could argue. Janet Yellen, Elizabeth Warren, the SEC.
Both Vivek, who is an advisor to Trump, and the VP candidate JD Vance is very pro crypto.
Yeah,
and so you can.
So there's a wide gap between the parties.
I don't think Biden knows what Bitcoin is.
Yeah, but Janet Yellen and the appointments. I mean,
that's not the point. The point is, it has nothing to do with the Democrats. I don't even understand why we're even putting them in the conversation. The conversation is not even regarding Trump. It's regarding JD Vance and Ramaswamy, who are very, very, very big proponents of Bitcoin. And so obviously, if Trump gets a second term, that influence is going to be very great on
Yes, it is.
on the Vivek and the JD Vance scenario. And so yeah, crypto from the moment of, honestly, the moment of that assassination attempt, and thank God nothing occurred there. Thank God we are not seeing what America looks like if the ultimate would have occurred there. So outside of that, don't want to really get into it that much, but yeah, Mark, I think what we're seeing is the JD Vance selection playing out here.
And this is not for me just, oh yeah, catalyst algos, right? You remember at the heart, this is for me, the heart of my pro Bitcoin, the heart, why I'm always calling it church, while is the institutional adoption theme, right? Like, the Bitcoin becomes incorporated within the financial institutions, and it becomes a legitimate asset class from now to the end of time. That process is well underway. A Trump administration would further that along. I think it's a legitimate catalyst. We're seeing legitimate price action.
Again, JD Vance, Vivek, who's going to be in the administration, they're both pro Bitcoin. Trump has came out and suggested that he is not going to support a federal backed crypto, U.S. digital currency. There's no other way to describe the gap and the hold other than that Bitcoin is part of the Trump trade.
Yeah, and that institutional, I mean, for me, because that's what it's always been for me. I could care less about crypto.
Give me two sectors that you would say would also be part of the Trump trade. And we'll do a podcast on the.
Yeah, we're going to do a whole podcast on this. A whole podcast on this. I think energy is the easy one. Deregulation.
Yeah.
Like, drill, baby, drill. But it's not just that, it's the deregulation. Yeah. It is the ability that, and I think finance through lobbying is also going to be a huge, massive winner along the same lines. And there's lots of other stocks, that areas of the market.
Two easy ones, right?
But, yeah, like softball stuff. Softball stuff.
Are the two easy ones. Bitcoin energy finance would be the softball lobs on there, but I find it be a fascinating conversation. I also find it interesting because when you do have presidential turnover, right, you obviously have massive differences in policy, and the market's going to price those things in, and the market doesn't price things in over years. Like, yeah, I remember the market when Trump became president last time, the market priced in a lot in like the month and a half between the election and the time he actually did take office. That was all the way back in 2016. Market's not going to wait for that if they have an edge.
The markets are faster than ever. And so right now, betting markets overwhelming. About as high of odds of Trump winning as you could get reasonably at this stage in an election, right? Like, around 75% I'm seeing in some places. That's not certainty, but it is a ridiculous lean.
It is, and rightfully so. I mean, you just had the Republican National Convention, which they put on a very, very good convention. You also have obviously the assassination attempt, which gives Trump a lot of good grace, I would say, and rightly so. In terms of the betting markets, they're obviously going to respond to that. I think the betting markets have overextended there. We live in a 50-50 country. That race, the race is going to tighten up. It's going to tighten up. But I also think it is very important for us to understand what Trump's policies are and how they would impact what areas of the financial markets, both from a positive perspective as well as a negative perspective. And so I'd say give us a couple weeks on that one.
Yeah. So I mean, we are less than 4 months, Matt, away from the election. I imagine you were going to see us on the. Yeah. You're going to see us on the podcast do a Trump winners podcast coming up, and then as the election gets closer, probably a series of podcasts because it will become the primary story in the market, and talk about the ramifications, what's been priced in, what might not have been priced in, right? So it's going to be a lot of election coverage, which too political
from a market perspective.
From a market perspective,
we'll leave the political hat off.
We'll try to leave the political hat off. We'll try. Hot take. I'm gonna give you a hot take. Hot take. All right. So we did not talk about it in this podcast. We will next week, because not this week, but the week after, the Fed meets, July 30th, July 31st, a very highly anticipated Fed meeting coming up. Next podcast, in the midst of earnings season, we'll take some time to highlight it, because we'll also have market price action, and a more important Fed meeting than your average Fed meeting. Matt, I have is that a countdown clock? No, that's not, is it?
No.
Was there a countdown clock? It's like, do you really, do they start counting down to the next Fed meeting?
I closed out of the pop-up as fast as it could. So like, no, it's not.
All right. So almost nobody is betting that there is going to be an interest rate cut. I got a hot take.
Please. I need you to rephrase that. You said almost nobody. 95.9 plus 4.1 equals 100%. Nobody is expecting the Fed to do anything other than cut between now and September.
Okay.
100% of the entire market expects that. Only 4.1 in July.
If the market wobbles here, right? Because I don't think you can argue the market's wobbled. Your average stock's up over the last 2 weeks pretty substantially, actually,
Tech's down, the rest of the market's up.
Yeah. But if the market has a moment, right? Like one of those,
sell everything moments,
like those type of things, and maybe not even dramatic sell everything.
So, Mark, let's talk about this very quickly, because Mark, if we spend a lot of time talking about an increase in support level and the pivot analysis, let's say support doesn't hold in the Russell. Let's say support doesn't hold in the Dow Jones,
and we're back to the breakout level.
The support doesn't hold in the ARKK. Let's say the Nasdaq violates the 50-period daily moving average. In that scenario, you could have a pretty quick sell everything moment. In that scenario, exactly. I don't find it to be the most likely scenario.
No, but you cannot discount it from planning scenarios.
Simultaneously setting a support that could work out to the
because that's one of those things. It's like, okay, what will I do if this occurs from a trading portfolio
in the environment where the market violates support simultaneously, and we say a red bloodbath on that
especially in a week where you're just done with OPEX, a lot of gamma unclenches, meaning things can happen.
What's your hot take?
All right, hot takes. Fed announces a cut in July. Not that they're announcing one in no, they cut in July. You see a statement come out at 2 p.m. saying the Fed has lowered interest rates immediately. I think they will absolutely respond to that. They want to. That's how it's been communicated. If the market goes through a moment, I strongly believe that you'll get a cut in July.
Let me ask you a question. This does not have anything to do with economic data. So are you suggesting, regardless of the economic data, that if the market has a
we've seen markets do this to the Fed before,
because the market is going to test the Fed and see how convicted they truly are.
And Matt, it's just one of those things where I'm like, I don't. Once again, it's not my basic.
Does the Fed have is it's kind of like Jerry and Chris
zero
testing how much gas is in the car. You remember that one episode?
Yeah, that's good. That's a good reference.
So I could definitely see it, Mark. I mean, there is a scenario where, and again, there is a debate whether July versus September. I'm in September at this point. I can understand that.
There's no debate, and we're the only ones debating that right now.
Yeah, there is no debate. None. It's 100%. I could see them doing something. I could see them doing something. Now, would I think it would be a mistake? Yes. And do I think the market would sell that emergency cut? I do think the market would sell that emergency cut. If the Fed is cutting,
gold wouldn't sell it.
I'm sorry. The rationale and the reason of why the Fed is cutting is vitally important. If the Fed is cutting due to emergency economic situations, the market will absolutely sell that moment. It will.
What if they spin it and
there's cut will be seen as a weakness. It will, and rightly so. It will be seen as weakness. But if the Fed is cutting because the economy is doing fine and they're just simply trying to alleviate the restrictive territory, the market is going to be perfectly fine in that environment. So it depends on what's triggering the sell-off. Is the sell-off triggered from a economic situation? Is it or is it just the market throwing a temper tantrum because they want to get a cut, which we have seen play out in the market?
Which we've seen that before. It's been a while since we've seen that. Like last time we saw that was what, late 2018?
It's been a while. It's
been a good 6 years.
The last time I think the market threw a temper tantrum to get what they wanted on the central
was the end of 2018.
It was December of 18. It was the plunge protection team being called in on Christmas Eve is what it was. You remember?
I'll never forget.
Yeah, they all had to be called in, and the plunge protection team had to, give confidence.
Well, listen, the market was down, and Steve Mnuchin mishandled the situation so badly that
you don't call the plunge protection team in an open meeting. You know, like the market, hey, we're bringing the 5 heads of
and finally, like,
on Christmas Eve. Well, how does that sound for optics? Hey, we're going to get the plunge protection team together.
Hey, all I know is it created a beautiful, like, 4-month rally that, it was.
But
okay, but listen, and we'll talk more about this next week. A couple listener questions as we close out the podcast. This is something that we want to do moving forward. Matt and I have been on the trading lounge at Tackle Trading every day this week. It is a combined halftime report with elements of the trading lounge. It's a fantastic product for our pro members, and we field questions during that while we're providing up-to-date analysis on a daily basis to our members. It's a fun it's cool, it's relaxed, it's fun, it's informative. A great reason to try to be a member. But we get a lot of questions in there, and we want on the podcast that if you have questions, email them in. You can email them to me at team@tackletrading.com, and we'll field them. Matt, the number, I just want to highlight, we haven't
hit us up in Discord. That's the best way.
Discord, another way. But anyways, get a hold of us. Get a hold of us. I'm old. Email, Matt's been making.
Oh my goodness! Hey, email me. Like, send me a page.
Send me a page. Fax me. Fax me.
Anyways, what's the question?
Anyways, first question, and this has been, and I'm going to paraphrase a lot of different people at the end of the week. Protection. Should I buy it? Right? Like, and I was come in different forms, different fashion, different phrasing, but you get a couple down days, and all of a sudden people start talking protection. And so how would you generally answer protection-oriented questions as we start into the week?
I don't recommend buying insurance in short-term pullback scenarios against the market. I find that to be wasted opportunities over time. I think it's when you're talking about portfolio protection, that's usually you're looking at the S&P 500, and traditionally you shouldn't be buying insurance at the top end of a parabolic uptrend against the all-time high price action in the marketplace. You want to give up a little bit of that price action. And so in the long term, I would say no to the insurance side of the equation, but the insurance side of the equation is a portfolio insurance. Do I also think it's important to have bear hedges on? I do. I think it's important to have some bear hedges, but I think you can certainly take that just from a standard trading perspective to make sure that you got some bearish trades out there to offset some of that bullishness, because there are scenarios, Mark, where, like I said, the Russell doesn't hold support. Dow Jones doesn't hold support. ARKK doesn't.
Yeah, if we have a sell everything, you're not going to see counter trends in bearish setups.
No.
And I want to make this point because it's an important one. If you did have some wobble here in the market, bearish setups are not going to counter trend. They're going to break and run. Like,
they're going to break. And because, again, a lot of the market is setting at a support level, whether that's a support level in a deeper retracement, or a support level in neutrality, or support level in a bullish uptrend. A lot of it is setting at support, and if support doesn't hold, you could see some downward pressure on price. So although I don't believe, when you are looking at RSP, a recent breakout, when you are looking at the S&P, a consistent bullish uptrend for the last year and a half, I don't believe that's the moment you buy insurance from a portfolio perspective. I think that's more proper reversal analysis on weekly charts. But I do think it is important to have bear hedges. And whether you're looking at bear hedges from a hedging perspective or you're looking at it from a short-term trading perspective, having some hedges out there against some of this market volatility, Mark, like if the market confirms and goes up, you're going to lose money on those hedges.
Right. Listen,
But you're going to make a heck of a lot more on the bull side of the equation.
Matt,
So
I am a big, huge believer.
do you like hedges right now?
Yeah, I'm a big, huge believer of maintaining some hedges. Like, I mean, one of the reasons I had such a good week is, the stuff I owned tended to do well. And my hedges in other places tended to do well. I mean, like that doesn't always happen, but having a few hedges, I'm a big believer. I'm a big believer in it. Like, even if I'm doing primary bullish plays, man,
what are you hedging? Are you hedging the next month? If you're hedging the next month, it's better to do it from a trader's perspective. If you're hedging the next 6 months because economically you think we're going to be going through some difficult times, then it's better to buy portfolio insurance and just park it there. So it really just depends on what you're trying to accomplish. I like some hedges. I don't like portfolio insurance right now.
Two more questions. The next one, Matt, any interesting earning plays on companies reporting this week?
Oh, of course there is. How much time do you got?
You got 60 to 90 seconds.
Okay, 60 to 90 seconds. I'll say CMG here.
Yeah, you mentioned that earlier. I actually wrote down that. I didn't comment on it, but I wrote it down when you mentioned that.
CMG here, I like it for a variety of different reasons, but one of the reasons I do like it is CMG is a stock that traditionally is very, very consistent on implied volatility. And when you are very, very consistent on implied volatility, you can map out trading systems around that. And so CMG, whether you're talking about, a short strangle, which is certainly more viable on a company with a $53 price tag versus a $3,000 price tag. So CMG, welcome to the earnings party there, baby, because you're now talking about one of the most consistent volatility cycles with a low dollar stock that is extremely liquid. So I think CMG is one of those interesting ones this week. And whether you're talking about the short strangle and, maximizing theta and maximizing volatility, it's a little bit more of an aggressive scenario, but it's the one I do personally like on CMG, or whether you're talking about more of a conservative approach like a broken wing butterfly or an inverted butterfly. If you wanted to do it like that on CMG, that would make some sense. A Debicon, if you're looking to hold a little bit longer term than just the actual announcement, does make some sense as well. But CMG's volatility cycle is extremely consistent. Both on the build up, which is the one I typically do prefer, is the volatility build versus the volatility sell. But you'll during earnings season, it's all about volatility crushes. So CMG stands out to me. I would look at CMG, but outside of CMG, there's a lot out there. General Motors would be another one that I think you could do a fairly conservative earnings play. The volatility cycle isn't nearly as much. Tesla is a really good volatility play as well, and you could certainly expect to see volatility come out on Tesla, but Tesla's also going to move fairly aggressively as well. Google, a little bit more. Google obviously can be played, but I would say the one that stands out would be CMG. Google's got a very consistent volatility cycle as well. And it's not just the volatility cycle that's consistent. You want to see the range is fairly big here as well, so that you can get that volatility coming down. I would say Google post earnings, bull put, bear call, credit, depending on what we're seeing from a price action. In front of earnings, I think CMG stands out.
Final question, different variations of it came in this week. Would you do anything on big cap tech before earnings, right? And we got questions on, should I buy the dip, to would I sell naked puts? We got a variety of these type of questions on big cap tech, which of course, when tech sells off a little bit, you're going to get some questions.
Not in front of earnings. No, not on anything in front of earnings. No, there's too much heat here. There's too much indecision. There's too much volatility, too much random price action. You got short distances going into Apple's report here in a couple weeks. Don't get me wrong. Like Apple here, I could see it. It's a good retracement. It's just sitting on the 20. So Apple, maybe Apple, but when you're looking at the rest of them, Google has earnings this week. Meta's got some issues from a technical perspective. NVIDIA.
I love this. Did you see the Zuck come out and talk about how much he loves Trump?
Listen,
Zuck loves money.
If somebody trusts anything Zuck ever says, so I would say the only one that makes sense to me would be Apple, but you would have to see a confirmation there. So I would say no in front of earnings. Taiwan Semiconductor I have interest in. I thought the gap down was a little nonsensical, and I thought they got caught up in ASML. So Taiwan Semiconductor makes some sense to me, but it would have to be through some degree of pattern development, because you're sitting in a very, very difficult position when you're looking at Taiwan right now at the 50-period moving average. You need to see development. I would say that same thing. In general, if you are, I would say you're tinkering, you're not full position on anything, and you're very cautious and you're very tight on stop losses is what I would suggest. Technology is going to have a moment here, because I don't see this as of right now as the starting point of a massive sell-off against technology.
You would have to see the earnings story. The earnings story would have to deteriorate. And
not only would the earnings story have to deteriorate, Mark, you asked me a question on blended growth. Blended growth's at 9.7, 9.8% right now. You discount 4 of the 7 Mag 7 components, Google, NVIDIA, so on and so forth, you're at 5.7, 5.8%. And so tech's going to have a moment. It is. And so I totally understand the question, because I think it's on everybody's mind. Where is this sell-off going to conclude? And when it does conclude, we're going to want to pick up some tech stocks and get ready for tech. But I would say the same thing I say in all of these conditions. When you have the momentum start to fall and slow, which we had in late stage on the tech play, when you've given up support, momentum, standard and deep, you can't just pick it up like it's a retracement. You got to let that go through development, and that development, because there's so many scenarios, Mark, where people pick up tech early and they get blasted by a 9 EMA. They get blasted by a 20 SMA. You do not want to fight algorithms ever, 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 ever. And so when you're above the 9 EMA, you use the 9 EMA to work off a momentum analysis. When you're below it, you got to have some caution against it. And so, yeah, tech's going to be on the radar, but it's not going to be on the radar aggressively this week. There are some tech plays out there, but mega cap tech, let's let the development set in here. That's my philosophy.
Yeah, no, and even for a credit, because I will at times through what I do,
when you're in front of earnings,
it's hard to do it at that. And let me just be frank, you haven't had a big enough sell-off to make it worth the risk of a deteriorating technical pattern. Now, you go down 7 straight days and all of a sudden, well, no, I'm going to start being able to credit.
You haven't seen real selling yet.
But you haven't seen anything really. This is just like, if this turns into something, it's just the start of volatility. And so, because once again, remember when selling credit, your reward is capped. And so when you take risk, you need to remember
you don't catch
your reward is capped.
Any space. I don't care if you're a theta trader or
and this is what, if the knife really falls, I start to. But yeah, and this is where you and I differ a little bit. Like when you get into oversold, multi-week sell-offs, and all of a sudden naked puts to own.
There is a difference in an overextended coming into a major catalyst. I'm going to be a little bit more aggressive there. One day after you violate the 50 days, not that time.
That's not that time. That's what we both like. You ain't even close to that time.
It's not this week.
That's that time. So hey, listen, Matt, fun podcast. Really enjoyed it. Thought we dropped a lot of knowledge there. It's gonna be interesting week, right? Pro members come join us on the Traders Lounge every day. Matt and I will be there. We'll be back next week to talk some earnings, talk price action, talk a preview of the Fed. But Matt, send us out.
Yeah, if you love the podcast, best way to support the podcast, give us a nice little like and share on YouTube, or give us a nice little review on iTunes. If you are listening on any podcasting app, it usually does come through iTunes. And so love our podcast community, love our YouTube community at Tackle Trading. And if you're looking for an amazing community of like-minded investors, all helping each other navigate the financial world together, come over to tackletrain.com, sign up for a free 15-day free trial, and you can hang out with us every single day in the Traders Lounge as we navigate the financial world together. And obviously we update stocks in the news, earnings updates, technical analysis on the market every single day in the Traders Lounge. But we also take time in the Traders Lounge for your questions, your charts, your what you need on a day in, day out basis. Love the love the Traders Lounge at Tackle Trading. And so come over there to tackletrain.com, sign up for a free 15-day trial, and check out the Traders Lounge, check out the newsletter, stay for all the community, but have an absolute wonderful rest of your week.
Yeah, take care, everyone.